The live cattle export ban continues to dominate agribusiness. While a resumption of trade appears possible within a few weeks, two issues are bubbling. One is obviously compensation, the other is the status of contracts. And does government intervention count as force majeure? Force majeure is French for superior force and is a common clause in contracts that essentially frees both parties from liability when events beyond the control of one or other of the parties prevents the contract being fulfilled. Now, those events usually mean war, strikes, riots, earthquakes, floods or volcanic eruption. But government edict? A legal nightmare or legal picnic, depending whether or not you're the one paying the bill. The compensation issue, meanwhile, is so complex it's almost impossible to define. If MLA hands over the $5 million demanded by the government, who gets compensation? The queue would start with the out-of-work ringers, include the chopper owners, the truckies, etc., 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 and end with the ship owners, and $5 million would probably last about 2 or 3 days. Moving on now to the markets, and first to the sale yards, where the live export fracas has had little impact so far on prices. MLA analyst Tim McRae says southern producers should not be concerned about cattle from the north for several weeks and possibly months.
Undoubtedly for northern producers this issue is impacting them immediately, but for southern, it's once those cattle start to flow into southern and eastern markets where we'd really feel the impact of those greater numbers, and that's months, 6 to 18 months down the line, I think.
In the meantime, the dollar is having the major impact?
Look, ever since post-Easter, the high dollar has really been hitting exporters hard, and that's flowed right back through the chain. The heavy end of the market has been getting hit very hard, and again, it's both the high dollar hurting us into Japan, but also a very weak US dollar helping US product into North Asia.
So prices came back in most categories. The biggest problem appears to be the feedlots, where the dollar is making margins very, very tight. Now, another point worth noting at the moment is the price of hides, down 15% in just the past 2 months. Now to grains, where the latest forecast from ABARES is promising. The experts there are tipping 011-012 winter grain production to reach 40.8 million tonnes. That's 32% higher than the 5-year average. The ABARES forecast of wheat production to be 26.2 million tonnes varies somewhat with estimates from other industry bodies. Australian crop forecasters, Rabobank, the United States Department of Agriculture and the Commonwealth Bank are all tipping smaller crops than ABARES. Last week, local old crop demand weakened. Canola also dropped while sorghum fell with a bit of a thump. However, it should be noted that despite the falls, these prices are still well in advance of this time last year. Now to the key Chicago Board of Trade, and there was red ink everywhere as the American Senate voted to end $6 billion in subsidies for ethanol. So corn, which is used in the making of ethanol, crashed, and wheat followed, and so too did soybeans. On top of this, Russia announced it would soon be back in the export game for wheat, and in the background, of course, is the sliding price of oil. It's all linked, and it's all price negative. Australian futures reacted much the same. Falls were in excess of 5%. Back to New York now, where strong data from China failed to halt the cotton slide. India is reporting weak demand, and the bears are well in control of the cotton market. Sugar bounced a fraction and closed stronger. That sugar price is the best for several weeks, while further out cotton contracts are much weaker than that July figure. Finally to wool, which had yet another strong week. The news from Greece slowed the market a little, but analysts insist the major problem with wool is and will continue to be supply. And this is reinforced by the actual bales coming up for auction. Over the next 3 weeks, the number is down nearly 20% on this time last year. Last week, the Eastern Market Indicator lifted just under 1% to close at 1,431 cents. And that's the Landline check on prices.